If it isn't the oldest trick in the book, then it's got to be close, because opening ranges have been around since before I started trading in the early 2000s, and they are just as prevalent now as they ever have been. Hey there, John Henry here, SSFTG. If this is your first time swinging by the channel, I welcome you. I hope your trading has been evergreen so far this year. Don't forget to like the video and subscribe to the channel so you don't miss any of our new videos coming out every day. Let's take a ride through the old school playbook of the opening range break. This is a strategy that was designed, I mean, honestly, decades ago, around the idea that the market finds its balance in the first 5 minutes or 15 minutes or 20 minutes, etc. You get the idea. The market finds a balance in the first portion of the day, and then when the traders break the extremes of those boundaries, breaking above or below, then the market will want to continue in that direction of the break. Now, make sure to stick around to the end where I cover how we will still use these types of ranges today, decades after the strategy was created, but in a little bit of a different way. The concept was pretty simple, really. I mean, you know, you wait for the first 5-minute break or the first range to form throughout the day, and then you wait for the market to break the extreme and look for a continuation play off of that. Does this strategy in and of itself still work today? Sure, in some instances, but as I've said before, you know, context is everything, and there's a reason I say that over and over again. When we're talking about opening ranges, if the underlying trend is massively bullish, then a downside breakout might not necessarily be the best route to go. It may be more likely a beneficial trapping location. So again, context plays a big role into these opening range breaks, but generally speaking, when the market opens up, we've all seen it, when the open hits, the market goes ballistic. And then it kind of calms down for a little while. It's found its balance. That's the balance that we're looking for. Now, if we want to use hard numbers, that may be 5 minutes, it might be 15 minutes, but every day can be different. Some days it takes 4 minutes, some days it takes 45 minutes. You get the idea here. One of my favorite ways to utilize these is based off the fact that opening ranges offer another unique measurement that we can utilize throughout the day as areas of interest for both buying and selling pressure. So again, here is the opening range that we've got going on, and what we want to do is look for an opening range deviation. So if we measure this distance here, this is the first 5-minute bar on the chart, then we take this drawing, copy paste it, and we drag that new drawing up. We have now deviated it one level to the upside. Now, of course, the cool thing about deviations is that we can go up and down, but if we can combine these levels with confluence, we can really nail down amazing scalping points, if not full-blown turning points in the market. The best ones are when we can find a situation where both buyers and sellers are looking to do the same thing in the same place. Sellers taking profit and buyers entering are both buyers, and if they are agreeing on what to do, even if they're coming from different situations, it tends to move a little bit more predictably. This is a great example of exactly what I'm talking about when we're looking at combining these levels of confluence together. Here, we have a ginormous down move, right? Sellers are going to be looking for a continuation play, but the only way that they can actually find continuation with this upward gap, it's still an inside gap, but it's a pretty big up gap, they've got to enter in here just to make sure that they have enough room to get a 2-to-1 down to fill the full gap back down towards the lows. So because of that, this creates a zone of resistance for them as an entry point, which lands right there. Now, if we take the initial entry balance, the original 5-minute range here, and deviate this up, this creates a resistance zone just a couple ticks higher above that level where the sellers have to come in. We're creating a multifaceted zone for multiple reasons. Buyers looking for the outside break, continuation, taking targets into their deviated objectives, and sellers looking for long-term shorts back to the downside. It's a perfect storm for a scenario like this. Opening ranges can be powerful, powerful trading tools in our trading arsenal and can create massive turning points for both the buyers and the sellers, irregardless of the direction that you're looking for. They're very potent zones of interest that we need to keep our eyes on. Now, you know, again, like we talked about before, context is everything, and it makes a big part of the story in terms of the trading approach. Now, if you want to see how we use things like the opening ranges and other strategies during the live market times, make sure to register for a 1-week trial on the main page of SSFTG. It gets you in our VIP live trade room for a full week with me and the rest of the members so you can see how we approach the markets every single trading day. If you have any questions about opening ranges, new video topics, or anything in between, drop them in the comments below. I always love hearing from you all. Have an amazing day in the markets, and thanks for watching. Bye.